X Financial just delivered a massive bottom line beat paired with a top line miss. Adjusted EPS was, I mean, it crushed the 29-cent consensus, coming in at 65 cents.
Huge beat.
Yeah, but revenue completely missed the 190.6 million estimate, landing at just 146.4 million. Management even withdrew their Q3 quantitative guidance entirely.
Right. They cited a really uncertain operating environment.
Exactly. But here is the paradox we're exploring in this deep dive for you today. Despite losing over half their revenue year over year and, suspending future guidance, the stock actually reacted favorably. It ticked up 2.4% in pre-market trading to $5.52.
It's wild.
We've got their financials and management commentary right in front of us, and our mission today is to figure out how a company can shrink this rapidly and still see its stock price go up.
Well, that positive stock reaction really comes down to aggressive operational downsizing, paired with margin stabilization. When you look under the hood at their volume, loan originations plummeted roughly 70% year over year.
Wow, 70%.
Yeah, and active borrowers dropped by nearly 75%. So they are intentionally getting smaller. But the key mechanism driving the stock is that operating costs were slashed by half.
Right.
By cutting costs so aggressively, their sequential operating margin actually bounced back to nearly 20%, up from like 12% in the prior quarter.
Okay, let's unpack this, because it feels exactly like a retailer deciding to close all but its absolute most profitable flagship stores just to survive a brutal recession.
That's a good comparison.
You preserve your margins, sure, but I have to push back here. With revenue down over 56%, at what point does intentionally shrinking your loan book stop being a smart defensive maneuver and start becoming a fatal spiral? I mean, you can't just cut your way to growth forever.
No, that is a completely fair point. And it's the exact tension management addressed in their commentary. They're explicitly prioritizing balance sheet resilience and liquidity over near-term origination volume.
So they're choosing survival over...
Overgrowth, exactly. And when you look at the risk front, you see why. The credit picture is stabilizing, but it remains highly stressed. Early-stage delinquencies improved sequentially, but their older, 91 to 180-day delinquency rate is still elevated over 9%.
Right.
Plus, we have to talk about a notable provision they took this quarter.
The 95.3 million RMB provision, yeah. This is where it's crucial to understand how their funding model actually works, because it's not just standard loan defaults.
Right. In their ecosystem, X Financial works with institutional funding partners. And normally, there's guarantee money moving between them to cover potential loan defaults.
Okay.
Well, this quarter, one of those partners simply failed to return the guarantee money, as agreed.
Oh, wow.
Yeah, so X Financial had to take a nearly 100 million RMB hit on the chin just to provision for that missing cash. It really highlights the severe counterparty risks they face when the broader economic environment gets shaky.
That perfectly bridges us to what retail investors really care about right now, which is capital allocation. Because if the core lending business is shrinking and counterparty risks are biting into cash, why hold the stock?
Dividends.
Exactly, the massive capital returns. Management reaffirmed a semi-annual dividend of 28 cents per ADS, which is currently yielding over 20% annually.
It's massive.
And on top of that, they're continuing active share buybacks with $35.5 million still authorized on the program.
What's fascinating here is how those capital returns tie directly into their broader corporate strategy. Even though the stock trades far below its tangible book value, which normally triggers buyout rumors, management firmly ruled out taking the company private.
Right.
They view holding a U.S. public listing as a rare, highly valuable privilege for a Chinese fintech.
Right, because if they went private, regaining that U.S. market access later would be nearly impossible.
Exactly. So they are paying out these massive yields to keep investors anchored while they maintain that listing.
They're essentially paying a premium to keep their seat at the table. And here's where it gets really interesting, and a final thought for you to mull over as you watch this stock. We know they're intentionally shrinking the core business while, bleeding cash to pay a massive 20% yield just to keep their U.S. listing. But consider the shifting geopolitical environment. If U.S. regulators tighten auditing requirements for foreign-listed fintechs, or if Chinese regulators clamp down harder on capital outflows, could this entire strategy of maintaining a U.S. listing through high dividends suddenly become a massive regulatory liability instead of a strategic asset?
That raises a critical question. I mean, they're playing a very tight defensive game, but they're highly exposed to macroeconomic forces entirely outside of their control.
Exactly. There's a lot to keep an eye on here. Make sure to follow the show for your daily earnings coverage.